Welcome to a look at the crude markets with Vanda Insights. I'm Vanda in Singapore, 2nd of May 2017. Crude prices have been tumbling again. Compared with its post-November 30th peak of more than $57, Brent has surrendered nearly 50% of its premium. WTI crude has lost 57% of its premium in the same time. All this while OPEC has been diligently cutting back production for 4 months now. Russia, world's largest producer and the biggest collaborator in the production cuts outside OPEC, has also reached its target cut of 300,000 barrels per day. What has been casting a long shadow on the market, however, is that OECD inventories have not declined at the pace and scale that had been expected. US production has also been rising. If you compare with the trough of 2016, US output at just over 9.2 million barrels per day has risen nearly 800,000 barrels per day. Compared with the start of this year, it's up nearly 500,000 barrels per day. Now, while that may not be enough to offset the 1.8 million barrels per day that's being cut back by OPEC and non-OPEC, the fear here is that what if it does rise to a level where it neutralizes the cuts? OECD inventory data comes with a bit of a lag. So the market has been focusing on US stocks as a proxy since they are released on a weekly basis. Through the first quarter of this year, we saw a steady and substantial rise in US crude inventories, which made the market a bit nervous. Since the start of the second quarter, attention has shifted to gasoline because US has now entered its peak driving season. And gasoline inventories, somewhat counter-seasonally and counterintuitively, have been rising for the past 2 weeks. When data comes out this week, analysts are expecting another build in gasoline stocks, which could send prices down yet again. So what should OPEC be doing? At this point, it seems that the OPEC non-OPEC cuts are likely to be rolled over for another 6 months till the end of this year. The question is that enough? To my mind, OPEC needs to be in this as a marathon, not a 6-month sprint. The paradox here is that the more OPEC succeeds in its cuts, the more it raises prices and the bigger boost that gives to the US production. So when OPEC takes its foot off the brake, as it is planning to do, and to hand the rebalancing work back to market forces, the higher crude prices are at that time, the harder they could fall, because we're looking at potentially at least that 1.8 million barrels per day, if not more, of production coming back into the market. And then you'll also have the higher US production already in the market at that point of time. What it looks like increasingly is that the 1.8 million barrels per day that is being removed by the OPEC non-OPEC efforts might need to stay out of the market much longer. A fraction of that, perhaps indefinitely. Thank you very much for tuning in, and do join us again for a look at the crude market.